Hello and welcome to the lecture for Chapter 3. This is going to get a bit more complex than the first couple of chapters. In those chapters we looked at service businesses, so companies that didn't provide physical goods to their customers but instead provided a service, like Oli Hot Yoga in the example we did in Chapter 2. Now we're going to look at businesses that buy and sell merchandise, kind of like the bookstore downstairs as an example. So I'll talk about how to record and report inventory transactions. We'll start with how we acquire inventory, so purchases and all of the transactions relating to that, transportation and so forth. Then I'll talk about sales related transactions and how we account for gains and losses on the sale of assets as well. We'll include that in this chapter. So first, some definitions. So a merchandising business purchases inventory. That's the goods that they're going to sell that they put on the shelf. They purchase those goods from suppliers. They then sell those goods to customers at a retail price, which is higher than what their cost is, hopefully. So the cost of an object subtracted from the price we charge a customer for it leaves us with gross profit. That's what's left over after we subtract the cost from the sale of a good. That's a really important number for any business, but merchandisers in particular. Some examples of companies that are merchandisers: one would be Costco. They buy and sell things that they get from suppliers. Walmart's another example, and like I mentioned, our bookstore downstairs is another example. One thing to think about in terms of selling physical products is the way costs flow through the business. So there are two different categories of costs that are incurred. One is product-related cost, and the other is a period cost. So product-related cost is anything that we spend in getting that inventory into our business. When we purchase inventory and pay freight charges to get it to us and so forth, we're purchasing an asset. That inventory on the shelf is something that we own. So it would be on our balance sheet together with our other assets like office furniture and cash in the bank and things like that. So we purchase it, it's an asset. It continues to be an asset on our balance sheet until we give it to a customer. When a customer walks out the door with our inventory, that's when it becomes an expense on our income statement. Period cost, as an example, advertising expense, utility expense, rent expense, all of those kinds of costs that are not associated with a physical product, we expense those when they're incurred, so they never become an asset that sits on our balance sheet. Here's an example of a portion of an income statement for a larger company. You can see here that they're tracking revenue by each type of product that they sell. In this case, it's cars and things related to automobiles. Then they track the cost of those sales. So the revenue is what they charge the customer. The cost is what it costs them to get that product to their car lot, as an example. So then revenue minus the cost of the sale is the gross profit. So again, that's a very key number both in dollar terms and in percentage terms. So there are two ways to keep track of inventory. I'd have to say a good way and a bad way. First, the bad way, periodic inventory. That's where we don't have a system to keep track of inventory coming in and out of our business. Instead, we just record purchases as we make them. At the end of the period, so at the end of a year as an example, we would count the inventory to determine what the cost of the goods that left must have been. So in that scenario, we have what we start with, a dollar value for our beginning inventory. We add all of the purchases we make throughout the year. That tells us the total amount of the dollar value of goods that are available to be sold. At the end of the year, we count the inventory again, and we subtract that from the goods that are available to be sold, and that tells us the cost of what must have left our store, cost of goods sold. So the advantage of this method is that it's very easy to implement. It doesn't require any software. You could do it on a piece of notebook paper. So it's pretty simple. The disadvantage, and there's multiple ones, one is you don't know the result of how you're doing until you get to the very end of a period and count inventory. So that's not good. If it's a negative result, if it's less than what you expect, you really don't have any ability to say, well, why is it less than I expect? You can't determine if a particular sale was unprofitable or a particular product is unprofitable. You can't kind of dig into the root causes of the problem. And then lastly, it's difficult to catch theft. So if goods are stolen, it appears that they just left with a customer like any other sale would have been. The way that we're going to study and the way that most businesses do inventory now is perpetual inventory. So in that case, we're going to record flows into inventory and flows out of inventory. Kind of imagine, if you will, a manual system where you have a 3-ring binder and there's a page in that binder for every product that you sell. When you purchase something, you pull that binder down, you go to that page, and you add how many you just received of a particular item. You put the binder back. Later, when you sell something, you pull that binder back down, you subtract anything that a customer takes with them. So at any moment, you could look there without having to go physically count the inventory and say, this is how much we have of that item X, Y, or Z. So the disadvantage is you do need some software to really be able to do that efficiently. The main advantage, though, the advantages outweigh the disadvantage. One, you know the gross profit per each sale, per each item. So if it's less than what you expect, you can narrow that down and adjust your pricing if necessary. The other benefit is that you know the results throughout the accounting period. With each sale, you're recording the cost. You're not waiting till the end of the period to count the inventory. So those are some of the main benefits of that. So I have some transactions. So in this case here, we acquire inventory. It's just like purchasing any other asset. So in the first line here, we purchased $10,000 of inventory on account. Inventory goes up and accounts payable, what we owe our suppliers, goes up. And then when we pay our suppliers, cash goes down and accounts payable goes down as we take that debt off our books. So there's a couple of further things that impact our acquisition of inventory. One is purchase returns, allowances, and discounts. So sometimes when we receive inventory, it's damaged or we didn't get the right item or that sort of thing. When we contact our supplier and say, we got a problem here, the supplier can offer one of two solutions. They can either say, we'll send that inventory back and we'll give you a credit for it, or they can say, how about if we just give you a price reduction and you keep the inventory? Maybe you can fix it or something like that. In both of those cases, from an accounting perspective, we treat it the same way. We reduce the cost of our inventory because either it now costs us less in the case of an allowance, or we have less inventory in the case of a return, and we reduce accounts payable. We owe that supplier less money. So that's going to look like this. We purchase inventory on account, inventory goes up, accounts payable goes up. We realize that $800 of the inventory is damaged and we return it to the supplier. So we subtract $800 from inventory because we're taking that off the shelf and shipping it back. And we reduce what we owe that supplier by $800. Then when we pay the bill, we pay the net amount that's owed, $9,200, and we reduce cash and reduce accounts payable at that time. So purchase returns and allowances, there also is sometimes cash discounts that are offered. A lot of businesses will do this to try to get money flowing through their business faster. So those terms are expressed in the following format. 210 net 30 is the most common. What that means, the 2 represents the discount you can take. The 10 represents the number of days you have within to take that 2% discount if you pay your bill. And then the second half of that is, well, if you don't take the discount, if you don't pay within 10 days, then what do you have to do? You have to pay the net amount in 30 days, so the full amount. So the impact of that is to reduce the cost of inventory and reduce the amount you owe the supplier. It's really important to make sure that whenever you work in a business that receives cash discount terms like this, that they take them. It's low-hanging fruit. If you don't take the discount, in effect, you're paying 2% to use that money for 20 extra days. So that equates to a 36% annual interest rate. So it's very beneficial financially for companies to take advantage of that. Notice that the terms could also be different. It could be 115 net 45, it could be 320 net 60, it could be a whole variety of different terms, but the position of the number always determines what the meaning is of that. So the way that looks here is we purchase inventory. Again, the $10,000 inventory goes up, accounts payable goes up. They offer us 210 net 30 terms. So if we pay within 10 days, we reduce the cost of our inventory by 2% or $200, reduce accounts payable by that amount, and then we pay the net amount within the 10 days, the $9,800, which reduces cash and reduces what we owe the supplier. So transportation cost, there are two different terms for that. One is FOB shipping point, which means the title of the goods transfers to the buyer at the shipper's loading dock, and the buyer is responsible for paying the freight to get it to them. In that case, it also determines when the sale takes place. So if the shipper ships something on December 31st, it's in that year, even though it might not arrive until early January. So the buyer recognizes that they own that inventory on December 31st, and the seller recognizes they sold it on that day. The other type of term is FOB destination. That means the title transfers on the buyer's doorstep. So a good example of that is Amazon Prime, where they pay the freight to get it to you. It remains their goods until it shows up on your doorstep, and then it becomes your product. That's when and where the sale takes place. So now I want to talk about selling inventory. So when we sell inventory, we're always going to recognize two parts of the transaction. We're going to record the sale, and we're going to record the cost of the sale. So in this example here, we take $4,000 worth of inventory and we sell it to a customer for $8,000. So our cost is $4,000, we're charging the customer $8,000. So when we make the sale, if it's on account, we increase accounts receivable and increase retained earnings, recognizing revenue. Then we immediately recognize the cost of that sale. And for that, we reduce our inventory because some of the inventory, we've taken it off the shelf, given it to the customer. So that inventory gets reduced by the cost of it. And we recognize cost of goods sold, which is an expense. It pulls down retained earnings. And then we receive the payment from the customer like we would any other receivable. Now, as you can imagine, there are also some adjustments that can happen with that. So we may receive goods back from the customer, or we may offer them a discount if there is some problem with the goods. In this case, with the case of purchasing, we handled it the same way in both cases. Here we have to do a little bit differently. So if it's a return, we're going to reduce the sale and reduce accounts receivable, and then we're going to record that inventory is coming back and cost of goods sold is being decreased because we received inventory back that we can put on the shelf and sell to somebody else. If we give the customer an allowance and tell them to please keep the goods, then we just reduce sales and accounts receivable, but we don't adjust inventory or the cost. So in this example, the top set of transactions here is the same $8,000 sale of $4,000 worth of goods, and we offer the customer to please ship the goods, $600 worth of the goods back to us. Those goods cost us $300. So when we do that, we reduce accounts receivable. The customer now owes us less money. We reduce retained earnings as we reduce our revenue. And then we record inventory has come back into the company. We increase our inventory. And this is a little bit tricky. We increase retained earnings because it's a negative expense. So if expenses reduce retained earnings, a negative expense increases it. The example in the bottom is if we gave the customer an allowance. So in that case, we don't need to worry about inventory or cost of goods sold. We just reduce accounts receivable and reduce retained earnings. We might also offer the customer cash discounts because we may want to get paid quickly and so forth. If that's the case, the terminology is exactly the same as what I described in purchases. It's going to reduce accounts receivable and reduce the revenue we recognize. So we make a sale of $10,000 on account. I don't have the cost, then I offer 210 net 30 terms, so I reduce accounts receivable, reduce my sales. I recognize cost of goods sold and then receive the payment from the customer. So one other topic I want to cover is inventory shrinkage. What that means is that sometimes when we keep perpetual count of inventory, what is actually on the shelf is not equal to what is in our perpetual records. Why might that happen? Well, it could happen because of theft. People can take things off the shelf and walk off with them and we don't know about it. It could result from breakage. Maybe items fall off and get broken and nobody reports it to somebody else, so we don't record that in our system. Or it could be just a miscount. So a supplier says they shipped us 100, they were really only 95, and we didn't stop to count it when we purchased it. So there could be those kinds of errors. So if we catch those errors, or when we catch those errors, when we count inventory at the end of the year, we're going to reduce our inventory and recognize cost of goods sold at that point for that adjustment. It is important for companies to take cycle counts throughout the year because this generally results in bad news, reduced earnings. Okay, so we want to kind of recognize that throughout the year rather than having one big lump sum bad surprise at the end of the year. It also keeps our records correct. So when a customer calls and says, hey, do you have any of the X100 product in blue, we want to know that we look it up in our system and what we're looking at is correct. So cycle counts can keep it more, the information more trustworthy. The other topic I want to mention is gains and losses. So when we sell long-term assets, like sell a truck or sell a building or land or something like that, we're going to record what the proceeds are we receive from that relative to the costs that we have of that. So when the selling price is greater than the value that we had on our books for that item, we recognize a gain. If it's less, then we recognize a loss. But the important thing there, so gains are going to increase our retained earnings, losses are going to pull it down, just like revenue and expenses, but we're going to recognize that in a different way because we're not in the business of selling long-term assets, right? So we want to recognize that after operating income so that somebody reading our income statement can say, this is how they did for the core purpose of their business, then this other stuff also happened. So here's an example of that, June's plant shop. So she's got sales revenue, cost of goods sold, her gross margin or gross profit, those words are synonymous. She's got operating expenses, so selling and administrative, and then transportation out, the cost of giving goods to her customers. So she had operating income of $7,300. Now there were some non-operating items, things that aren't directly related to the core purpose of selling plants. In that case, she has interest expense and then she sold some land and had a gain on it. So that affects her bottom line net income, but it lets a reader see what was the result of the core purpose of her business selling plants. That was an operating income of $7,300. So that's the lecture for Chapter 3. I look forward to talking to you in Chapter 4. Thank you.